you. All right, everybody, welcome to the third day of our Power Lunch for Real Estate Pros. We are here on Wednesday, and I wanted to preview what we're going to see on Thursday and Friday in the hopes that I'll see you there as well. And then we'll get started with today's call. So tomorrow I am going to speak on delegate to dominate, how you can stop doing it all and start scaling smarter. So I'm really going to get into how you can build a virtual team to run your real estate business. It's what I do myself to run all my investing in 5 hours or less per week while traveling the world. And then on Friday, I'm really excited to have my friend Sheena here with us. Sheena is a CPA who specializes in working with real estate investors. She's a real estate investor herself, and she's going to share profits without panics, 5 CFO secrets to cut taxes and scale without stress. She's going to share these 5 strategies that help reduce taxes by potentially 50,000 or more and track your performance without a ton of spreadsheets and grow your real estate business with clarity. So we have some really cool topics coming up. And then we have today. So today we have Eric Nelson, very excited, great multifamily investor and syndicator here who's going to share why now is the time for multifamily investing. He's going to go through what makes it a great time for multifamily investing now and a framework for how you can scale there with purpose and intention. So, with no further ado, if I can stop my sharing here, stop. We'll go ahead and transition the ball over to you, Eric. Take it away.
Yeah, great to meet you guys, Jana and Heidi. It's great to see you guys, and I'm sure some other folks could jump in. And Noah and Adrienne, thanks for having me. I have a presentation, but at the same time, if there's things that come up or you have questions about real estate in general, please throw them in the chat. I love talking about real estate, so I could talk for hours and hours. I probably won't do that today. In fact, we might end a little early, just depending on how kind of this presentation goes. But ultimately, I am a real estate investor, and that's my passion. And I have a lot in common with Adrienne too. I'm currently in Italy. I drove from Croatia today to Italy, so it was kind of a wild day. And so, like Adrienne, I live in Spain, and we travel the world, and we do real estate from abroad. So it is possible. It's not like this white whale. I didn't come from money. It is very much possible to build a business where you can do it anywhere in the world. So I will now share my screen and see if I can get my presentation going. Let's see here.
I'll let you know when I can see it.
Okay. Hang on one second. Okay, this may or may not work. Okay, there we go. So let's see here. Can you see that okay?
Yeah, if you want to, let's see how it looks when you click that present full screen. Oh, it looks beautiful.
Cool.
Very nice.
Okay. I'm glad. This is speaking of VAs and delegating, my amazing VA, and I would say more like EA now, does all this stuff. So she puts this together for me with my input on what I think it should look like, and then she makes it look beautiful. So just another proof and concept. It does work, delegate the stuff you're not great at. So why is now the time for multifamily? Now, I will say that multifamily can mean a lot of different things, right? You could be buying a fourplex, or you could be buying 100 units. I buy a little bit of everything, to be honest. So literally under contract for a duplex at the moment. We just closed on an 80 unit about a month ago. So when I say multifamily, this does pertain to lots of people. It could be as small as a quad, could be even a house hack. But when I really speak about multifamily, that's really the world I focus on. That is larger. That is 50 plus units typically. If you've been following the trend, it's had a pretty rough, let's say 18 months. 2024 was pretty slow for multifamily. Lots of people had some pain in the market, but I think right now is a great time to be getting in, or right now is a great time to be getting educated. Might be a better way to say it, because we're swinging into this really good time to buy, in my opinion. So what will we cover today? I do syndications, and if you don't know what that is, basically what we do is we buy with a group of people. So if we buy an apartment building, we have investors that come in and they provide the money. Sometimes I invest in my own deals, sometimes I don't. But then we can purchase this as a group. So syndication just means a syndicate, meaning kind of a big group of people putting this together. Let's say by a $4 to $5 million apartment building, we're going to have 20 investors, give or take. And so there'll be a handful of us who take care of the project and the investors fund the deal. So any questions about any of that stuff, just throw it in the chat. So just like this is what we'll be covering today. What is syndication, becoming a syndicator, the rules behind them a little bit, how to get started, and then raising capital means how do you find investors? So we'll cover a little bit of that. And of course, there's a disclaimer that I always tell people, I'm not a lawyer, I'm not a CPA. What I do is know a lot about real estate. I've been doing it for a long time, and we'll kind of talk about all that too. Okay, so what is syndication? I just kind of talked about that a little bit. I like to give an example of a $4 million property. So let's say we just closed on an 80 unit we paid $4.2 million for. So it's a very good example. You could buy around 80 units in middle America for that amount. So that's $50,000 per unit, give or take. So let's say you buy a $4 million apartment building, you're going to need about 20 to 25% down. So let's just say you need $1 million down and you're going to borrow the rest from either a bank or some kind of lender. And so then you're going to need some other money to fix up the property because that's really the name of the game. So you're going to need around $2 million to buy a $4 million property to really fix it up and do the business plan like we do. So limited partners, LP, you kind of see on the screen there, those are the investors. And when I say limited, that means that they really don't have a say. So when they invest in a syndication, they own a portion of the property, but they sign documents that basically say, okay, I'm not an expert. The GP, the general partners, those are kind of the experts. We're going to let them run the deal. So that's kind of what the LP and GP stands for. And then together we come together and we take care of we buy the deal, we fix it up, and we'll get a little bit more into that as well. So what are the pros and cons of being an LP? So the biggest pro, in my opinion, is that you're not doing anything, right? You're totally passive. So when you invest in real estate as a limited partner, you literally just say, okay, cool, I like this property in, let's say, Oklahoma or Arkansas that this group is buying. I want to be part of it. I like the vision, I like their plan, but I don't want to do anything. Maybe I'm too busy, or maybe I just don't really want to deal with tenants, but I want to own some real estate. That's the biggest pro. But when we're comparing to the stock market, let's say, because that's passive as well, right? You can invest in Apple stock, or you can invest in Nvidia, or you can put your money in, that's passive also. So what are the pros and cons of doing something like this versus the stock market? Now, the pro is, generally speaking, you're going to get better returns, at least historically. That's always going to be dependent on the deal, of course, and depending on what you buy, but that's generally true. There's great tax benefits of the real estate. We talk about that a lot. You hear more about that on Friday as well. So when you invest in real estate, you get to defer some taxes along the way. And so then by the time we get to the end and you've received your entire amount back, usually the taxes are pretty low. So that's a great one. The con is it's not liquid. So when you invest in a deal like this as an LP, meaning a passive investor, it's not liquid. So it means that you can't sell it. So if you invest in Apple and you don't like what it's doing or you need the money, you can sell your stocks. In this case, you can sell your shares, but it's pretty rare. And we usually tell people that's not a great plan. So this is a more of an illiquid investment. So I usually tell people this needs to be money you're okay with sitting aside for 3 to 5 years. That's a con for some people. For some folks, that's great. But the other con is that you really must know and trust the team. So if you are investing with a GP or a group, it's important that you get to know them, meaning do some research, ask around, have the phone call with them. It's different than, again, investing in the stock where you can say, okay, well, I trust that Microsoft or Apple or some other publicly traded entity, they have a CEO that's well qualified, blah, blah, blah. There are times when you're investing in real estate with these people who maybe don't have the experience that you want to see. So make sure that they have experience, that they've gone full cycle, that they have a good track record, that they're trustworthy. You have to do a little bit of research, I guess is what I'm trying to say, unless you personally know somebody or have an intro to somebody who's doing this kind of thing. Okay, so what are the pros and cons of being a GP? So if you were like, I want to get my hands dirty, I don't want to be an LP, I really want to learn how to be a multifamily operator, I want to learn this stuff, that's what it's a general partner. So what are the pros and cons of this? The pro this is a pro, depends on if you're extroverted or not, is networking and building a community, because it really is. I think all of real estate is a relationship game. It really is who you know. It really is building relationships to partner with people, with lenders, with CPAs, with agents. I mean, there's always people involved in real estate. It is not an alone thing. So for me, that's a huge pro. I love talking to people. I love getting to know people. I like building a team. So that's a huge pro for me. The other pro is that you can do this without your own money. So you can do a syndication with zero of your own money. And that's, I say that with a little bit of a caution. You're going to need some money because you're probably going to need a website. You're going to need some training. But generally speaking, once you kind of have the foundation built, you can buy properties over and over and over with zero of your own money. So you're gaining equity by doing the work. So that's why syndication is so powerful, because you can kind of scale up. Sky's the limit. You can do it over and over and over. You never run out of money. Generally speaking, what happens with people in real estate is they might buy one or two rentals, and then unfortunately you run out of money, you run out of capital. So either you need to partner with somebody who has capital, or you get creative financing, or some other kind of situation like that. But in a syndication sense, the investors are putting the money in, so you don't need that. That's not really a problem. Now the problem becomes finding investors that trust you and that you're going to give a good return to. So the con is raising capital. That's what you see is the first one, is creating relationships again with investors who want to invest with you. And the other con is give up a large portion of the ownership. So investors own typically 70 to 80% of the deal, which is great as an investor. If you're an LP, sweet, you're buying, and that's, we love to treat our investors very, very well. They deserve a very good return. But as a GP, you get some equity, but not as much as you would with, if you're buying with your own money. So that would be, generally speaking, a con. But for me, I'm totally willing to give that because I really love my investors. So if you want to become a syndicator, we'll get more into this a little bit. What does that networking look like? What are the meetups, local things, stuff like that? So becoming a syndicator is what I mean by that is you're going to buy larger deals. You don't have to buy multifamily. You could buy self-storage, you could buy industrial. Generally speaking, if you're going to syndicate a deal, you want it to be worth, in my opinion, you want the deal to be at least $2 million. If it's under that, it's probably not worth the attorney fees and all the hassle with the paperwork and the kind of rules you have to follow. It might be better to set up what's called a joint venture, which just means you're partnering with a handful of folks. You guys all have a little say in the deal. But if you or someone is running the deal entirely, there's other people who are very passive, that is what the SEC considers basically not a joint venture anymore. So you have some rules to follow. So I always caution people, if you're partnering with some folks, let's say you have 3 investors and you're kind of running the deal and they're purely passive, kind of a dangerous place to be, honestly. The SEC views that as you selling shares. And so if you have investors, have a quarterly meeting with them, take notes, ask their opinion, really have them be involved. That's a true joint venture. So that's just a piece of caution. In the syndication world, we're not doing that. We are totally allowed to have passive investors. So anyway, so if you want to become a syndicator, you want to do that. The best thing, in my opinion, is you really need to get educated. I always say that. It's true of really anything in real estate. Education is number one. You're here, so you're in the right place. You're starting to learn about, or maybe you're just learning more about real estate. I highly encourage you to join some mentorship program of some kind. It's really, really valuable. It's worth every penny. I've done that. I think every syndicator I know has done that because education is so valuable. It's so important. You really want to be an expert before you take other people's money. Second one would be a coach, and you don't necessarily have to have a coach. It comes back down to mentorship. A group would be good so long as there's a great mentor for the group. I personally strongly believe in coaches. I believe in coaches for pretty much anything you want to get very, very serious about. So I had a coach for like 4.5 years and paid him every year. And I think it was worth the money and then some. But something to consider. It doesn't, again, I'm not just talking about multifamily here. If you're interested in flipping or wholesaling or anything really, if you can find a great mentor or coach or program, that's going to really springboard you. Okay, I talked about the rules, and I don't want to get too far in the weeds here because these can be a little bit dry, but it is important to know what the rules are if you're going to do syndication. So there is what's called a 506B and a 506C rule, and these are just basically what you're doing is you are following rules to be exempt from the SEC regulations, meaning you're just saying, okay, I don't want to be regulated, but I will follow these very specific things to have an exemption to selling shares. So basically what it is you're either going to follow one of these typically. You can have a 506B, which means you can raise money from pretty much any type of person, meaning as long as they understand the risks and as long as they are educated by you, they can invest in your deal. And that's called a non-accredited or sophisticated investor. If you're going to do a 506C, oh, sorry, back to the B really quickly. You can raise money from non-accredited investors, but you must have a relationship with them. And the biggest key is you can't advertise. So you can't blast it on Facebook and all that stuff. If you do a 506C, you can go crazy. That's why you see like Brandon Turner, you see other people blasting deals and putting stuff on the internet. That's because they only allow accredited investors. I won't read what the accredited investor stuff is. I will share these slides. You guys go back and look at it. Basically, it means that either you make 200 grand a year or 300 grand with your spouse, or you have $1 million of net worth, not including your house. So it just means you have had some financial success. I don't know why the SEC thinks that that makes you more qualified to invest, but it just means you probably have a little bit more money to invest, and you probably have some sophistication to understand that there's risks involved. That's the theory behind accredited investors. So again, you're not allowed to advertise. So that's the biggest key, the key difference. So if you're thinking about becoming a syndicator, thinking about doing larger deals, those are important tools to know. All right, so why now? This is really what the presentation is all about. Why now? Why right now? So a couple of things are happening. I've been shouting at the rooftops, I don't see rates dropping. I've been saying that for 2 years. People have been waiting for rates to fall back. And I keep saying, I don't think that's going to happen. For the first time in a very long time, I actually do think they're going to start. I think the Fed is going to start reducing rates this next year. What does that mean? It means, okay, now we're at, let's say, 6.5% interest rates. We might see them fall down to 6. I'm not predicting huge drops, but that's a big difference in a $10 million property. If you have a 6.5% interest rate and a 6% interest rate, all of a sudden you can pay more for it. Sellers are really looking to sell. And so if you can pay even just a little bit more, there's more transactions happening, which is great. I think this number right here in the bold, right here in the middle is really what's cool. 42% of all commercial real estates are maturing in 24, which is outdated, or 25, totaling around $500 billion. That is a large, large number. So $210 billion is coming due, meaning they either have to refinance or sell the property by the end of this year. That is a huge number. That means that a lot of properties are being sold right now. That's a great time to be looking at larger deals. 26 is going to be a similar number. So now is a great time to get educated. If you can get into the market soon and find these deals, now is a great time to be doing that. Well, here's some more facts around why now. And basically, I hate to say this, but people took short-term loans unwisely. And what they did was people had variable rate mortgages back in like 2020, 2021. It was very, very easy to get a loan at 3.25%. And you could get these variable rate loans or short-term debt where it's like 2 or 3 years. And it seemed like the best deal ever. Luckily, we never did that because I was like, this feels too good to be true. And it was. Unfortunately, for a lot of people, rates doubled. And all of a sudden, they're like, oh gosh, we can't really meet our debt service. We need to sell. And that's still happening to people. The debt is due on the loans that they took in 2020 and 2021 that were 3-4 year notes, sometimes 5-year notes. Maybe they got an extension. There are a lot of people who really do need to sell. I'm not suggesting that I want to be out there like taking advantage of anyone. I usually love a win-win deal. But if someone's in a position where they need to sell, I'm in a position where I want to buy. Hopefully we can find a deal that works for both of us. But ultimately, there is a lot of money coming due. If you look at the bottom, 2.81 trillion coming due by 2028. That is a ridiculous number. That is a huge number of loans that will be coming due in the next 3 years. Okay, what also happened was when things got tough in the last year and a half, 2024 specifically was hard. I saw a lot of people leave the market. I knew 200 syndicators, and I bet 150 of them have decided, you know what? I didn't do so well, or maybe I lost some investor capital. I'm done with that. Luckily, we never did. We haven't lost any money, and we haven't had any capital calls yet. So we're just like, all right, well, let's just stay the course and only buy great deals. I love this quote. You've probably seen this before. Hard times create strong men create good times create weak men, and weak men create hard times. And it's this cycle that we see. And I should say women because this power lunch is really all about women, except for me. But you get the point. Basically, if we have a little bit of a hard time, you can kind of stick it out. We're going to see some really great things come from sticking the course. I think that's probably true for a lot of things. But that's another reason why I think right now is a great time. There's a little bit less competition out there. Okay, so here's just a bit about me. What I will say is I was able to move my family to Spain, living basically entirely on real estate and real estate transactions. And really, there's nothing special about me. It was just a goal we had. And I only started in 2019. So 5 years, I was able to quit my job, do what I love. I love real estate, live in Spain, and kind of travel the world. And I say that not to brag, it's just to say, so can you. And it's really nothing new. I didn't reinvent anything. I'm just sort of borrowing from people ahead of me. I love podcasts. I love reading books. I love being on podcasts. I had my own. I love having guests on. So I was just sort of asking people, what is it that you did that what created the success? And that's kind of the key for everyone, so to speak, is just copy what you're hearing and what you're seeing, and you can totally do it. And what I'll say is it's out there. The information is out there. Lunches like this, podcasts are a really great resource. I really highly recommend a mentorship of some kind or some kind of group if you're really interested. But this slide is just to say I was able to do it, and there's nothing really crazy about it. It just took a little bit of dedication, and I think more than that, consistency. So whatever it is that you're doing, make sure that you have the wherewithal to understand, okay, I'm going to do this a little bit at a time for a very long time. That's what I always tell people I'm mentoring is consistency is way more powerful than motivation. Motivation sort of fades off. If you can say, I'm going to do even an hour a day or 45 minutes a day of this type of thing, it can lead to some very large things. Okay. So if you're like, all right, cool, where do I get started? That's a great, like, I'm liking this. I'm like what I'm hearing. How do I even begin? What's step one? Step one is tell everyone what you're doing. And I know that sounds crazy because you're like, well, I'm new. What does that mean? Um, it means that you are going to become a real estate investor. So you start telling all your friends, start telling everyone you know, hey, I'm going to be investing in real estate and I'm going to have some investment opportunities coming. And I'm talking specifically if you're going to partner with people or have investors with you, start telling everybody, even if you're just going to go out and use your own money to start, tell people because you'll be surprised where deals come from. Start telling everyone, start going to meetups in almost every major city, specifically in the US. Go to meetup.com and type in real estate, and you will find meetups around your area. Start going to those. Start talking to people, telling them what you're doing. The second step is get serious. We'll talk a little bit more about that as well, but this is not like just for fun. This is going to change your life, hopefully. So take it seriously. And then I think the most important thing, and I talk about this a whole lot, I created a course, and the very first video is called The Bottomless Why. And I talk about why are you doing this? And I will touch on that a little bit right now is let's just say, okay, I want to make more money. Great. Or I want to quit my job. Great. Why do you want to quit your job? Well, I don't like my job. Okay. Why don't you like it? Well, it takes all my time. Okay. What are you going to do with your time? Well, I like to spend it with my family. Why do you want to spend it with your family? Well, I want to make a bigger impact on my kids' lives. You get the point. Just continually ask why, and you'll get down really deep into, oh, okay, well, the whole reason I want to do this is so that I have time with my kids and I can show them part of the world. And that's really what drives me. So that's my why, but you can find yours, right? Maybe it's, I just want to hang out and be on the beach. Great. Or maybe it's, I want to buy a giant house. Great. Whatever that why is, make sure that you have it so that you know this is what's going to be that thing you think about to continue to keep you motivated. Okay, so the next step is going to be raising capital. So if you're going to be partnering with folks or raising capital, again, network. It is all about people. Even if you're an introvert, you really want to figure out what it is that's your superpower and start telling people that. So if you're super introverted, maybe you're just a numbers person, great. That is an excellent skill. Start telling people, hey, I like doing Excel. I like analyzing deals. I like tracking spreadsheets. I like doing budgets. I'm telling you, that's an amazing, amazing skill. So even if you're not an extroverted person, tell people what your superpower is, start networking and meeting people. And you'll see network on here twice. That's there for a reason. I used to think networking was like, I don't know, kind of cheesy, I guess, because in the corporate world, it can be a little bit, it's like you go to these luncheons or whatever, and networking is in some cases can be, in other cases, it's truly people giving you free value. What Adrienne's put together here is incredible. You get a week full of lunch with crazy value. This is networking. So put your name out there, connect with her after all this stuff. Make sure that you're just continuing to say, hey, Adrienne, thank you for putting this together. I'm grateful for it for sure. Hopefully you are. What's your superpower? Who do you need to connect with? She can connect you, connect dots, create, tell you what kind of mentorship you might need, all that stuff. That is networking. It's not cheesy. All right, so I've kind of hit the end of my slide sheet here, but I can, again, talk about all kinds of stuff. So any questions out there, feel free to unmute yourself or toss it in the chat. And I have one more slide I'll end on. If you want to connect with me, and I think Adrienne can share this stuff as well. Here's my email. I answer my own email all the time. If you want to look more into what I do, I have a mentorship program. I'm not here to sell that. But if you want to learn more about it, happy to talk about that too. So yeah, if you have any questions, anyone want to unmute themselves, I'd love to answer anything that's out there.
This is
All
Heidi.
right, guys. I know.
Oh,
Great.
so-
Go ahead, Heidi.
Go ahead, Heidi.
no, well, first, thank you for your time. I'm in the process of learning everything, and this is, like you said, it's truly very valuable. So I appreciate it. Did you start out with the syndication right away? Is that how you began doing real estate investing?
Oh, wow. I totally skipped my story. That's I'm glad you called me out, Heidi. Thank you. I was in such a rush to get into multifamily. I forgot to tell my story. So no, I did not. And I think most people don't. I think you absolutely can. So if you're like, I am hyper motivated, I want to scale to the moon, I want to get 100 units. It's very possible to do that. I think more likely it's better to buy a rental or two and really kind of understand what it's like. I usually tell people it's also nice to become a landlord. So one very good tool to start is called house hacking. So maybe you either rent out a room in your house, or some people find that a little too intimate. So what my wife and I did was we bought a triplex. We don't live in it now because we live in Spain, but when we moved back to Colorado, we will still live in that. We have a duplex behind our house. So we bought a house that happened to have two rentals behind it. That's a very good tool to get started in real estate. If you're like, I'm not doing that, great, no sweat. You could also just buy a rental property, or you could partner with someone to buy a rental property or duplex or something and get started. So how I got started was I was an engineer by trade. I studied civil engineering. Quite honestly, the only reason I went that route is because I was good at math, and my parents and people were like, "Oh, you should be an engineer." But it never really felt like a passion. I just sort of finished college, started engineering and working for somebody, and I was kind of like, honestly, from day one, I felt like I was just punching the clock. And then what really hit hard was when I did the math on how many years I need to put money into my 401k before I could retire. And I was like, oh, I have to work longer than I've been alive, is honestly the conclusion I came to. And I was like, I was like 30 years old. I'm like, ugh, this is brutal. So I started looking around at other things, what's out there. And I happened upon real estate. And so if you find places like Bigger Pockets is a very valuable tool. They have, back then, between episodes 200 and 300, that's like the sweet spot was what it was for me. Brandon Turner was just a very good host, and he just taught a lot about real estate and stuff, and it just resonated with me. So I listened to a ton of those. Then I finally bought a rental property. And then we bought one more with a partner, which was my father-in-law. but we were out of money. We were young and had no money. And so I was like, well, now what, you know? So the next thing I did was I started looking at what does creative financing look like? And so what I did was my son was just born, our first son. So this is 7 years ago, gosh, 8 years ago. Crazy how time flies. And I would push him around in a stroller, like go street by street. Every for rent sign I saw, every for sale sign I saw, I'd call them and I'd say, hey, I'm interested to buy, especially the rental properties. Hey, I see you have a rental. Looks like a great property. I don't want to rent it, but would you sell it? And then if they're like, yeah, maybe, then the next question I ask is, do you know what seller financing is? And that basically just means that they act like the bank. And the reason I wanted to do that was hopefully I could find someone who would finance it where I didn't have to go get a loan from a bank. And maybe I could have a low down payment, use a little bit of cash or like less cash than normal, right? That's that's a risky way to do it. But if you're buying the property right, meaning you're buying below value, that's a really good tool. So I happened upon a sixplex. I talked to the owner. He was literally like hammering a for rent sign in the ground. It was hilarious. And I said, hey, looks like a great property. Would you be interested to sell? And he said, yeah, but I don't know what it's worth. I inherited this from my mom. Like I'm kind of tired of being a landlord. It was like everything he was saying was like hurt like music to my ears because I was like, I'm not tired. I'm ready to be a landlord. And if you're tired and you own it outright, which is what he did, he had no debt on it. I was thinking, well, maybe he could sell our finances for me. So we got to talking and we kind of became friends. And this was over a period of time. It was over like 8 to 10 days. I would just give him some time to think on it. So finally he said, okay, yeah, I'm ready to sell, but I need $1 million. And he thought that was just an astronomical number. He thought I would just think he's crazy. But in the market where I live in Colorado, that's actually quite a good deal for a sixplex. So I said, okay, I'm not even going to haggle with you. $1 million sounds great. I will pay you the million, but will you finance it as the owner financing it? And he goes, well, what's that? I said, okay, well, it basically works like you act like the bank. And the cool thing is you get a check every month and I'm just going to pay you instead of paying the bank. And you have a lien on this property. So let's say I can't make my payments or I get sick or whatever, you get this property back from me. So basically you've got some money from me and you get the property back and it's probably been improved. So that's usually how I sell people on seller financing. I really do believe in it a lot. I think it's a win-win. Plus, you get to defer that taxes over time. So if I gave you $1 million and his basis was zero, the next year he would pay capital gains on $1 million. So, it'd be a huge number. So he's like, cool, all right, I like this plan. And I said, all right, let's do some math. So I did the math. I was like, your check from me will be right around the amount you're getting in rent. And you have to do nothing. You're just going to collect money. The reason it worked out for me was because he was under rented. That he was renting them for way under market. He just been doing the same thing over and over and over, never raised rents, never really improved the property. He just didn't have any cash. So it's like, no, it makes sense. I was like, okay, cool. How about we do 3% down and I'll buy a property for $1 million and you finance the rest. And he's like, cool, let's do it. So I paid $30,000 down, which was still a lot of money at the time, for $1 million property. And it turns out there was an empty unit. So I went in there and personally fixed up the unit, did all the plumbing and everything, basically created a sixth unit and brought that online. And so now I was making a couple $1,000s a month because I raised rents and I had another unit and I was paying him. He was making the same amount as he was. And that was a great deal for him. So Heidi, very long answer to your question was I started with buying rentals first, then creative financing, that kind of stuff. Then I was like, all right, I'm really ready to scale. I'm really ready to go to syndication and go from 6 units to 100. And what does that look like? So that's kind of my story. So thanks for asking.
Oh, thank you. And
Yeah.
you, I guess, learned how to do that through the Bigger Pockets podcast. And so while you were doing the 6 unit, that's when you were also studying, how can I launch this into something larger?
Yeah, truthfully, I never really, my original goal when I first set out was I just want to set up myself for retirement. Like, cause I didn't want to worry about my 401k. Cause like I said, I was worried if I have to wait 30 years to build my 401k, it's going to take forever. So I thought I'm going to buy one apartment per year for 10 years. That was my original goal. And then I'll have 10 of them after 10 years. And by the time I'm 45-ish, let's say, I'll have a pretty decent retirement. That was my thought. So I didn't really ever plan to scale. It just turned out that opposite of engineering, real estate became my absolute passion. So for me, it was like, oh, I love this. Now I don't want to do engineering anymore. How can I scale? So it kind of naturally progressed. To answer your question about syndication, it's a bigger beast. Syndication is a little bit level up. So I really believe that you need a mentor or somebody. So I hadn't ever heard the word syndication, never heard of multifamily in a larger scale, even when I was doing those, like, 6 and 3 unit deals I was doing. And I went to a meetup and I met a guy who was doing syndication, and so then I paid him to be my coach for the next 4 years. So I didn't really seek it out. In fact, in Bigger Pockets, this was before Brandon Turner was doing syndication. So he now has shifted gears. Now he talks about that a lot, but back then he was doing single family stuff as well. He was buying a lot of them in Washington. That was around the time he moved to Hawaii. So if you follow Bigger Pockets, I mean, I'm kind of dating myself because that was years ago, but he was only talking about single family stuff, and all the guests they had on were just buying a lot of single families. So that was where my mind was, just from that particular resource. He then shifted, right? So if you follow Bigger Pockets, he kind of had the same trajectory as me, just a little faster, because he was super, super motivated, had a really good following. He's just a great guy. So nothing bad to say about Brandon. He just kind of had a similar trajectory, just a larger scale. Anyway, all that to say, so I didn't really seek it out, other than I met someone who was doing it. And then he's like, I think you'd be good at this. And to be totally honest with you, I sort of fought it. I was like, I don't know. I don't have investors. I don't really want partners. I kind of like what I'm doing. And then over time, he wore me down. He's like, no, you definitely want partners. You go way further, way faster with partners. And you do have the skill that you could do this. And I was like, all right, let's try it. So I started looking into multifamily and syndication, and I realized, okay, he's right. Partnering is great, and basically any of real estate, by the way. So even if you're only buying duplexes, highly recommend partners. But he sort of coached me into, here's how this works, and here's what it looks like, and so I wasn't really seeking it out. It just sort of found me, and then now that's why I'm so passionate about it. Is I hadn't heard it, so why aren't people talking about this more? Adrienne had me on her podcast. This is what I say. I'm like, it feels too good to be true. Sometimes it is. Sometimes you lose a little money. It's usually not. It's usually you invest your money passively. Someone else does all the work and you get a return. You get to be an investor. That's amazing. So if you're me, I like to shout it out to people like, look, it's a great deal for investors. And if you really want to be active, it's a great way to get scale in real estate. So again, I feel like it was a very long answer, but I'm glad you asked those questions.
Thank you.
Yeah. Adrienne, what were you going to say?
I was going to ask Eric, because usually people need some warming up to ask questions. So I feel like Heidi gets a gold star for being ready to go. But I was going to ask, from your story, Eric, is, like a lot of us, you started with some sweat equity. Like you mentioned that sixplex, and you went in and like renovated that unit yourself. But now you really emphasize that time, that location, that freedom that you've had, where you're not having to be in the trenches yourself. And so I'm wondering what wisdom you would have for people here, as you learned that lesson, and have created that freedom. What would you recommend people have as like pillars or a framework for building a real estate investing business that really supports lifestyle goals and not just financial ones, like the wisdom you learned to create the life you have now?
Yeah, I love that. I think what you're going to talk about tomorrow about delegation is going to be extremely important. So I believe that you have these things that you're good at, and you have these things that you're not so good at, or maybe you don't like doing. As soon as you can find someone to either partner with, or if you can afford it, pay them to do the things that you're not great at, or both, you're going to start building that framework, exactly like you said. If you're trying to do it all, which I was early on, it becomes pretty exhausting. I mean, you're kind of chasing your tail, and you're like fixing broken stuff, and you're doing the leases, and you're, asking tenants for money when they're late. And it's really frustrating. So there are people who do this stuff, right? Like when you buy a property, I was not smart enough to do this. Make sure there's margin in there for a property manager. A professional is much better at it than you. They might care slightly less about the property than you, but they do that for a living. So I always say, all right, give yourself 10% for a property manager. And every deal you're looking at, even if you're going to manage it early on, there might become a time when you get tired of it and you want to hire the manager so the deal can still support it. That's just one example. Two would be if you have some tasks that you're not great at, like building this sheet you're looking at right here. I'm not really great at Canva. You know, I'll follow my way through, but it'd be pretty engineering, right? Like I still can't get away from blocks and it wouldn't look pretty. So find those people who are good at that type of thing and begin to release and delegate and build the framework around what is it that your goal is. Now, again, if your goal is freedom, that's what you're doing. If your goal is to scale, then start to build everything you do. Think about, okay, what if I'm going to do this 3 more times? How would that help me? So then you're like, all right, let's build framework around pretty much everything. People talk about systems and process. You talk about it all the time. If you listen to a podcast, you'll hear that. What they really mean is every time you do something, just create or write down what you did so that you can give it to someone else or that you have a framework around doing it again that's much faster. You know, the first time doing everything is hard. Second time's way less hard. The third time should be like a breeze or someone else is doing it. And so that's what I would recommend is continue to think about who you can partner with or pay to do the things you don't want to do, and then stick to the things that you're really great at and you love doing. Great question, Adrienne.
Awesome. Thank you.
Yeah, so I put the QR code up here. I mean, again, I'm not here to sell the mastermind. If someone's interested in more information, I love chatting. So it's not that I'm trying to sell you on it, but I like to put it up here. This is what I created. When I started, I didn't have a place like this. There wasn't like a group that I could go to ask questions, to gain partners, that kind of thing. So that's really what I've created. So I'll stop sharing so you don't have to look at that anymore. But if there's any other questions, feel free to get and toss in the chat. I haven't looked at the chat, Adrienne, so I don't think there's any in there.
It's mostly me
Oh, okay.
commenting and writing down some gems. So
Oh,
I
no
don't think
sweat.
there's any
Okay,
questions,
cool.
but I'm sure that
Oh,
there's
I
some
see
other
Tammy
questions
said so
we'll
true.
have.
Okay.
Yeah.
Yeah, no sweat. If you, again, I mean, I love talking. So again, my email is eric@wildoakcapital.com. So feel free to message me there. Heidi, thanks for all the questions. I see you're on. Oh, Janet, go ahead. I see your hands up.
Eric, I'm wondering where you're investing. Are you investing in the southern United States primarily? Do you have some parameters as far as locale and exactly what you're looking for? Do you consider new build, development? I know a lot of people are going that way for multifamily because of the degradation of old buildings and things like that. So I just wondered where your focus is.
Oh yeah, great question. So we invest in Oklahoma and Arkansas and one market in Texas only. So Tulsa, if I could buy everything in Tulsa, it's my dream city for investing. I just think it's like a great place to live. All the metrics are there. I just think it's a great place for investing. And I also think it's kind of a cool city. If they had skiing, I would live in Tulsa probably, but they don't. And but anyway, so that's a great market. That's where we focus to start. We kind of branched out from there into Arkansas, a little bit into Texas. What I will say is, this is just my opinion. Basically, take all of Middle America, and there are hundreds of markets that work for real estate investing. So you can basically, and this again, my opinion, I take off the whole East Coast. I include Florida. I don't invest in Florida. Insurance has kind of gone nuts there, you know, hurricane seasons and all that stuff. I don't invest there. Some people have great success. I don't. East Coast can be a little bit not so landlord friendly and very expensive. Northern United States, I'm not a huge fan of freeze thaw cycles. Cities like Chicago can be tenant friendly as well. It's not that I don't want to be tenant friendly. It's just the laws can be hard for certain things. Like it can be very expensive for evictions, things like that. So it's not like I'm like this slumlord. In fact, we have what we call our motto at Bottle Capital is people first. So I'll do the market thing and I'll come back to that motto because I don't want to forget that. But if you look at Middle America, anyway, from Indianapolis all the way down to call it the edge of Phoenix, maybe, there's this wide swath of places that make a lot of sense. Of course, West Coast is, again, in my opinion, too expensive. So you can kind of cut that out. Some of the Sun Belt is hyper competitive. And then if you're along the coast of the Gulf, same story, you're going to have crazy insurance. So like all over the United States, there's places that you can invest that work really well. Middle America, in my opinion, is the best place. And there's lots and lots of markets to look. So we look at Tulsa area and surrounding. I know lots of people have success in Kansas City, Indianapolis, Oklahoma City, Wichita. I mean, you could name literally hundreds of markets. So you asked if we look at new stuff, and this actually comes back to our business model. You probably hear the term value add. And what that means is when you fix up a property, you're forcing appreciation. So when you buy multifamily, you're buying a business, and that's kind of true for rental properties, but there's a little bit more emotion involved sometimes in the sale process. When you buy multifamily, you're buying a business, and so you look at the income and expenses and really the NOI, and that is the net operating income. So the operating expenses removed from the operating income gives you that number, and that basically divided by the cap rate, or basically the market amount, gives you the purchase price. So it really is a very math-driven game to buy multifamily. And so what we want to do is buy those tired properties. And so when you say maybe there's some dilapidation or maybe some deferred maintenance, that's actually good for us because we want to go in there and improve the property, make it a better place to live. There's two things we do. One is we're going to improve exterior and interior, so it's a nicer place to live. What that does, of course, is we can charge a little bit more rent for that. Also, what we do is we have tenant events. We think about what tenants want. So like, let's say we have a monthly event where we give like a pizza party or like a back to school thing, or like give donuts and coffee away monthly. Try and get people to be in a community. We usually do dog parks. We'll do like kids playgrounds if there aren't some there. As a parent, that'd be huge for me. If I live in an apartment, I could look out and see my sons play. I'd be like, yes, this is great, right? So you're trying to create a community because turnover is expensive, and it's also like, we want the people to love where they live. So I'm okay with some dilapidation, to answer your question, and I'm a little bit afraid of development personally, just because there's some heavy risk there. So from my perspective, the risk reward for new development isn't quite there. Also, if you look at a downturn of how it looks where people migrate in downturns, most people move from the nicest apartments to a little bit less nice apartment because their budget's less, right? Like that's what most people do. So the highest and nicest properties I typically avoid, mostly just for downturn, and there really isn't a way to force value. So if you have like an AA class property, you have all the amenities, it's a beautiful place to live, that might be a great place to live, you know, for certain folks, but I don't really necessarily want to own that property because I can't add any more value. It would just be like, you know, owning a really nice property. So what you tend to find is a lot of like family offices, large funds, those types of things who need a little bit lower return. Those types of investors typically own those type of properties. So that's a long answer again to say I'm more interested in value add properties in middle America than I am in any development or the nicest properties. So hopefully I didn't get too in the weeds there for you. Oh, and I think I covered the people first thing. So I'm glad I came back to that. But yeah, we really care about our tenants. And what it does is it creates a community, but also creates a little bit more value for us too. So it's kind of a win-win. Thanks for the question, Jana. I think that's pretty much it. So Adrienne, I'll let you take it away. Thank you so much for having me on. This has been an incredible group. It's been a pleasure.
Yes, thank you so much, Eric. This has been really helpful. I think a lot of information shared. And guys, if you want to catch any of that again, because I know there was so much, remember that we're going to email out all the recordings. Are going to go onto my YouTube channel. We're going to have a whole series. So again, if you missed a call or anything, that's all going to go out after Friday. After the last one from the week, we're going to put the whole playlist of all 5 presentations out on there and email it out. So, and then tomorrow, like I'm going to speak. I'm excited to share about Delegate to Dominate and really get into like building a virtual team and everything. So I hope all of you can join us tomorrow for that. And I'll see you then.
Thank you.
Thanks, guys. See ya.